Look, I need to tell you about something that happened on August 15th, 1971, and I guarantee you this moment changed your financial life, even if you weren't born yet. President Nixon appeared on television on a Sunday night, interrupting the most popular show on television, and announced that the United States would no longer convert dollars to gold. Just like that. No warning. Foreign governments had been trading their dollars for American gold because they were nervous about inflation, and the United States was running out of gold. So Nixon just changed the rules. Countries around the world woke up on Monday morning holding billions of dollars that were supposed to be backed by gold, and suddenly they weren't backed by anything except a promise. The French were furious. The Germans were shocked. The Japanese didn't know what to do. But here's the thing that nobody really understood at that moment. Nixon didn't just end the gold standard. He created the biggest financial trap in human history. And today, China is caught in it with $3.2 trillion they can't get rid of without destroying themselves. Let me explain exactly how this trap works. You're watching something right now that most financial commentators won't touch because it exposes how fragile the entire global system really is. My name is David, and I spend way too much time thinking about why countries make decisions that seem completely insane until you understand the game they're forced to play. If you're someone who watches the news and wonders why China doesn't just stop buying American debt, or why they don't dump dollars and crash our economy, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. By the end of this video, you'll understand the exact mechanism that keeps China locked into financing American spending, even though they know it's a terrible long-term deal, and you'll see why this trap gets tighter every single year. As usual, I need to tell you a story. Let me take you back to Mexico in the 1970s. Oil prices were skyrocketing. OPEC had the world by the throat, and Mexico, which had massive oil reserves, suddenly looked like the smartest economy on the planet. The Mexican government started borrowing money. Lots of it, mostly from American banks in New York. Here's what made sense at the time. Mexico would borrow dollars at relatively low interest rates, invest that money in oil infrastructure, sell oil at high prices, pay back the loans, and pocket the difference. The math worked beautifully. American banks were desperate to lend because they were flooded with petrodollars from Middle Eastern countries that needed somewhere to park their cash. Mexico was happy to borrow. Everyone was making money. By 1982, Mexico owed about $87 billion to foreign banks. That's roughly $300 billion in today's money. But here's the catch. All of those loans were denominated in US dollars, not Mexican pesos. Step 1, Mexico borrowed billions in dollars. Step 2, they spent those dollars building infrastructure and expanding their economy. Step 3, oil prices started falling in 1981. Step 4, interest rates in the United States skyrocketed because Paul Volcker at the Federal Reserve was fighting inflation by raising rates to nearly 20%. Now think about what this meant for Mexico. They had borrowed dollars when interest rates were 7 or 8%. Suddenly, they were paying 15 or 18% on that same debt. At the exact same time, their main source of revenue, oil exports, was generating less money because oil prices were dropping. And because their debt was in dollars, they couldn't just print pesos to pay it off. They had to earn dollars through exports or use their foreign currency reserves. Why would they borrow in dollars instead of pesos in the first place? Because American banks wouldn't lend in pesos. The peso could be devalued by the Mexican government at any time, which would mean the banks got paid back in cheaper currency. Dollars were stable, dollars were safe. Or so everyone thought. But here's what nobody calculated. If your revenue is in pesos from your domestic economy, and your debt is in dollars, and the peso loses value against the dollar, your debt doesn't just stay the same. It gets bigger in real terms. You need more and more pesos to buy the same amount of dollars to make your payments. In August 1982, Mexico's finance minister flew to Washington and told the IMF and the US Treasury that Mexico couldn't make its debt payments. Not that they didn't want to, they literally couldn't. They were out of dollars. Within 48 hours, the entire Latin American debt market froze. Banks that had lent hundreds of billions to Mexico, Brazil, Argentina, and other countries suddenly realized those loans might never be repaid. Major American banks like Citibank and Bank of America were facing potential bankruptcy because their loans to Latin America exceeded their total capital reserves. If Mexico defaulted, the entire banking system could collapse. So what happened? The IMF stepped in with emergency loans, but only on the condition that Mexico implement austerity measures, cut government spending, raise taxes, devalue the peso, open markets to foreign competition. Mexico had no choice. They took the deal, American banks got bailed out, they didn't lose their money. Some of them actually made profits by buying Mexican debt at a discount and then getting repaid at full value through the IMF rescue. Meanwhile, ordinary Mexicans saw their savings evaporate as the peso lost 80% of its value over the next few years. Wages collapsed, unemployment skyrocketed, an entire generation lost their economic future. And here's the kicker. The American banks that made those risky loans knew the whole time that if things went bad, governments and international institutions would step in to save them. They privatized the profits and socialized the losses. So what does this have to do with China holding $3.2 trillion in US currency and debt? Everything. Just like Mexican politicians thought they were making a smart bet by borrowing cheap dollars to invest in oil, Chinese leaders thought they were making a smart bet by accumulating dollars through trade surpluses and buying US Treasury bonds. Just like American banks profited from lending to Mexico while passing the risk onto taxpayers, the US government profits from Chinese dollar accumulation while passing the consequences onto future Americans. And just like Mexico got trapped in a situation where they couldn't escape without destroying themselves, China is trapped right now. Imagine you own a small business, let's say a bakery, and you have a customer who buys $10,000 worth of bread from you every month. This customer is by far your biggest account, responsible for maybe 40% of your revenue. But here's the thing. This customer doesn't actually pay you in cash. Instead, they give you IOUs, little slips of paper that say they'll pay you later with interest. You accumulate these IOUs month after month, year after year. After a decade, you're holding $300,000 in IOUs from this one customer. Now you start to get nervous. You're thinking, maybe I should stop accepting IOUs and demand cash. Maybe I should even sell these IOUs to someone else and get out while I can. But then you realize the trap you're in. If you stop accepting IOUs, this customer will stop buying your bread. You'll lose 40% of your revenue overnight. You'll have to lay off workers. Your ovens will sit idle. Your business will shrink dramatically. Okay, so maybe you decide to sell the IOUs you already have to someone else. But here's the problem. If you try to sell $300,000 worth of IOUs all at once, you flood the market. The value of those IOUs crashes. Maybe you only get $200,000 for them. You just lost $100,000. And it gets worse, because everyone else who holds IOUs from this customer sees you dumping them and panics. They start selling too. The value crashes even further. Now your remaining IOUs are worth even less. You've destroyed your own wealth trying to escape. And there's one more twist. Let's say you somehow managed to sell all those IOUs and got cash. What are you going to do with $300,000 in cash? You need to invest it somewhere safe that pays interest, or inflation will eat away at its value. Where do you invest? Well, the safest, most liquid investment in the world is, you guessed it, IOUs from that same customer. You're right back where you started. This is exactly the situation China is in with the United States. China sells goods to America. Everything from smartphones to furniture to industrial equipment. Americans pay for these goods in dollars. Chinese companies receive those dollars and convert them to yuan at Chinese banks. But the Chinese government doesn't want too many dollars floating around in their economy because that would strengthen the yuan and make Chinese exports more expensive. So the People's Bank of China, their central bank, takes those dollars off the market and holds them as foreign exchange reserves. What do they do with $3.2 trillion? They have to invest it somewhere. US Treasury bonds are the obvious choice. They're considered the safest asset on earth. They're liquid, meaning you can buy or sell them easily. They pay interest, and there's a massive market for them. But now, China is stuck. If they stop buying US debt, the value of the dollar falls relative to the yuan. Chinese exports become more expensive. American consumers buy less Chinese stuff. Chinese factories shut down. Unemployment rises. Social unrest becomes a real possibility. The Chinese Communist Party's entire legitimacy is based on delivering economic growth and rising living standards. If that stops, their grip on power is threatened. So they keep buying dollars and US debt even though they know it's a trap. What if they try to dump their existing treasury holdings? Let's say China decides to sell $1 trillion worth of US bonds. They flood the market with supply. Bond prices fall. Interest rates spike because bond prices and interest rates move in opposite directions. Higher interest rates mean the US government has to pay more to borrow money. American businesses have to pay more to borrow. Mortgages get more expensive. The stock market probably crashes because higher interest rates make stocks less attractive. The entire American economy could go into recession. Now you're thinking, wait, wouldn't that be good for China? They hurt the American economy and escape the trap. Here's why that doesn't work. If the American economy goes into recession, Americans buy fewer Chinese goods. China's export economy collapses. Plus, if bond prices fall, the value of China's remaining treasury holdings falls too. They just destroyed $3 trillion of their own wealth. They shot themselves in the foot to spite America. It's mutual assured destruction. Except China has more to lose because their economy is more dependent on exports to the US than the US economy is dependent on Chinese lending. And there's another layer to this. What would China do with the money they got from selling US bonds? They'd have $3.2 trillion in cash. Where do you park $3.2 trillion? The entire global bond market outside the US is smaller and less liquid. German bonds, Japanese government bonds, British gilts, none of them can absorb that much money without massive price distortions. Gold? The entire global gold market is worth maybe $12 trillion. If China tried to buy a substantial portion of that, gold prices would skyrocket, they'd be buying at inflated prices, and they'd be holding an asset that pays no interest and costs money to store and secure. Real estate? Same problem. There's no market big enough to absorb that much capital without creating insane bubbles. So who benefits from this arrangement? The United States government, obviously. We get to borrow money at artificially low interest rates because China and other countries are trapped into buying our debt. We've been running massive budget deficits for decades, spending way more than we collect in taxes, and foreign governments finance that spending. American consumers benefit because we get cheap, imported goods from China. If China stops suppressing the yuan, those goods would cost more. But here's who really wins: the financial institutions that facilitate all of this. Investment banks that underwrite treasury auctions. Currency traders who profit from the spreads. Asset managers who collect fees on the trillions of dollars sloshing around in the system. They hide the true nature of this arrangement in 3 specific ways. First, they talk about it in language that makes it sound boring and technical. They say things like China is managing its currency peg or recycling trade surpluses into reserve assets. That sounds reasonable and normal. What they don't say is China is trapped in a financial hostage situation where they have to keep lending to us or destroy their own economy. Second, they focus attention on the debt number itself, the 3.2 trillion, and debate whether it's too high or whether it's concerning. That's a distraction. The number doesn't matter, the trap is what matters. Third, they present this as if it's a choice China is making freely. You'll hear analysts say China chooses to buy US debt because they trust American institutions or because they want a safe haven for their reserves. That's partially true, but it ignores the fact that they don't have better alternatives. It's not really a choice when all your other options are worse. Here's what you need to understand emotionally. This isn't about one country outsmarting another. This is about a system that was designed, intentionally or not, to create dependencies that benefit certain groups at the expense of others. You're not a victim of China or the US government. You're a participant in a global financial system where the rules were written before you were born. And those rules determine what your money is worth, what you can buy, and how much debt your government can take on in your name. So what do you do about this? Here's an immediate defensive move. And I'm not going to give you some basic advice you've heard 1,000 times, like diversify your portfolio. You already know that. Here's something specific. Go into your retirement accounts right now, today, and check how much of your bond allocation is in US Treasuries versus other types of bonds. Most target date funds and balance funds are heavily weighted toward US government debt because it's considered safe. But if you understand what I just explained, you know that safety is based on the assumption that countries like China will keep buying our debt forever. What happens when that changes? Maybe it doesn't happen this year or next year, but at some point, the math stops working. When that happens, Treasury prices could fall significantly. You don't want your entire bond allocation in that basket. Look at adding exposure to Treasury inflation-protected securities, TIPS, which adjust for inflation. Look at short-term corporate bonds from companies with strong balance sheets. Look at international bonds from countries that aren't trapped in the same debt spiral we are. I'm not saying sell all your treasuries. I'm saying understand the risk you're taking and adjust accordingly. Most people don't even look at this. They just assume bonds are safe and that's the end of the analysis. You're smarter than that now. Here's the second thing, and this is psychological. Stop thinking about dollars as this permanent, stable thing. The reason China can't dump dollars is because everyone believes dollars are the safest, most liquid asset. That belief is what gives dollars value. But belief can change. It happened in 1971 when Nixon ended the gold standard. It happened in the 1920s when the German mark hyperinflated. It happened in ancient Rome when they debased their currency. It can happen again. I'm not saying it will happen tomorrow or that you should panic and buy gold and canned food. I'm saying keep a portion of your wealth in assets that aren't denominated in dollars. Real estate, if you can afford it. Stocks and companies that generate revenue in multiple currencies. Even a small position in hard assets like precious metals or commodities. The biggest mistake people make is assuming the current system is permanent because it's been around their whole lives. The dollar has been the global reserve currency since World War II. That's almost 80 years. That seems like forever if you're 40 years old. But in historical terms, it's nothing. The British pound was the global reserve currency. Before that, for about a century. Before that, it was the Dutch guilder. Before that, the Spanish dollar. Reserve currencies change. It doesn't happen smoothly. It happens in crises. Here's what most people don't realize. The reason China holds $3.2 trillion in dollars isn't because they're stupid or because they're secretly controlling us or any of the conspiracy theories you hear. It's because they made a rational decision 20 years ago to build an export economy, and that decision locked them into this trap. Every year they stay in the trap, it gets harder to leave because the numbers get bigger. If you hold 100 billion in treasuries and you want out, that's manageable. If you hold 3 trillion, it's not. The trap tightens over time. And here's where it gets really interesting. The United States knows China is trapped. We've known for years. That's why we can run massive deficits without worrying too much about bond markets panicking. We have a captive buyer, but that captive buyer is getting restless. China has been slowly reducing the percentage of the reserves held in dollars. Not dumping them, just buying less than they used to and diversifying into other things. Gold reserves at the People's Bank of China have been increasing. They've been setting up currency swap agreements with other countries to trade in yuan instead of dollars. They launched a yuan-denominated oil futures contract to try to chip away at the petrodollar system. These moves are small and gradual because China can't afford to spook the markets. But the direction is clear. They're trying to build an exit ramp from the trap, even if it takes decades. What does that mean for you? It means the era of the US being able to borrow unlimited amounts at low interest rates is not going to last forever. At some point, probably not this decade, but maybe the next, we're going to face a reckoning. When foreign governments stop buying our debt at the rate they have been, interest rates will rise. Government spending will have to be cut, or taxes will have to rise, or inflation will have to rise. There's no free lunch. The bill always comes due eventually. Now you might be thinking, okay, this is all interesting, but what am I supposed to do with this information? I'm not a central banker. I can't change the global financial system. You're right, but you can change how you position yourself within that system. The people who get destroyed by financial crises are the ones who are completely exposed to a single point of failure. They have all their money in one currency, one asset class, one country. When that thing breaks, they're wiped out. The people who survive and even thrive are the ones who understand the risks and spread their exposure. Think about Mexico in the 1980s again. If you were a Mexican citizen who had all your savings in peso-denominated bank accounts, you lost 80% of your wealth when the currency collapsed. If you had some of your money in dollars, in foreign real estate, in gold, you were okay. You might have even made money. The same principle applies now. Don't put all your trust in any single system, no matter how stable it seems. Here's another thing nobody talks about. The China-US dollar trap creates incentives for both countries to avoid direct military conflict, which is good, but it also creates incentives for financial warfare. We've already seen this. The US has used the dollar's dominance as a weapon by cutting countries off from the SWIFT banking system, which is basically the network that allows international dollar transactions. We did this to Iran. We did it to Russia after Ukraine. China's watching this and thinking, if we ever have a serious conflict with the US over Taiwan or something else, they could do the same thing to us. They could freeze our treasury holdings. They could cut us off from dollar transactions. That's why China is so desperate to reduce dollar dependence, even though it's economically painful. And the US is watching China try to reduce dollar dependence and thinking we need to maintain dollar dominance at all costs because it's the source of our geopolitical power. This creates a really dangerous dynamic where both sides are locked in a financial system neither fully trusts, and both are preparing for the possibility that it breaks down. When systems are under that kind of stress, unexpected things happen. Let me give you a specific example of how this plays out in weird ways. China has been buying massive amounts of physical gold for years. They don't report their real holdings accurately. Everyone knows the official numbers are fake. Why are they doing this? Gold doesn't pay interest. It's expensive to store and secure. It's not useful in modern transactions. But gold has one critical property. It can't be frozen or seized easily. If China holds $3 trillion in US Treasury bonds and the US government decides to freeze those assets for political reasons, China loses everything. If China holds $3 trillion in gold bars stored in Shanghai, the US can't touch it. It's insurance against financial warfare. This is the kind of thinking that happens when the system starts to crack. And you should be thinking the same way on your personal level. What assets do you own that can't be frozen, seized, or devalued by a single government decision? Cash in a bank can be frozen. Stocks can be restricted. Real estate can be taxed or even confiscated in extreme circumstances. I'm not saying any of this is likely. I'm saying these are the kinds of tail risks that people in positions of power are already preparing for, and you should at least be aware of them. Here's the psychology shift you need to make. Stop thinking of the financial system as this neutral, permanent infrastructure that just exists. Start thinking of it as a game with rules that benefit certain players and trap others. The United States designed a game after World War II where the dollar became essential to global trade. Countries that wanted to participate in the global economy had to hold dollars. That gave us enormous power. We could print money and export inflation to other countries. We could borrow cheaply because everyone needed dollars to buy oil and other commodities. We could sanction countries by cutting them off from the dollar system. China looked at this game in the 1990s and decided the best way to win was to become indispensable to American consumers, make products so cheap that Americans couldn't resist buying them. Accumulate dollars, buy US debt, tie the two economies together so tightly that America couldn't hurt China without hurting itself. That strategy worked brilliantly for 20 years. Chinese GDP grew at 10% a year. Hundreds of millions of people were lifted out of poverty. China became the world's manufacturing center. But now, China is realizing they made a devil's bargain. They're rich in dollar terms, but they can't actually use that wealth without destroying its value. It's like being a billionaire on paper, but all your money is in one stock you can't sell. You're not really a billionaire. You're just trapped. And the United States is realizing that China's strategy of tying the economies together means we're trapped too. We can't decouple from China without massive economic pain. We can't stop them from buying our debt without interest rates spiking. It's a mutual hostage situation, which is probably the only reason we haven't had a serious military confrontation. So where does this end? I'll tell you what I think, and this is speculation, but it's informed speculation. Over the next 20 to 30 years, we're going to see a gradual breakdown of dollar dominance. Not a sudden crash, but a slow erosion. China and other countries will continue building alternative systems. Digital currencies, both government issued and private, will give countries more options for international trade. The percentage of global transactions conducted in dollars will decline from around 60% today to maybe 40%. That doesn't sound like a lot, but it's enough to change the game. When that happens, US interest rates will rise because we'll have to compete for buyers of our debt instead of having captive buyers. The US government will face hard choices about spending. Either cut programs, raise taxes, or accept higher inflation. None of those options are politically popular, so we'll probably do some combination of all three in a chaotic, poorly planned way. The average American will feel this as a slow decline in living standards. Things will cost more, wages won't keep up, retirement accounts won't grow the way they used to. But here's the thing. If you understand this process, you can position yourself to protect your wealth and maybe even benefit. The people who get destroyed are the ones who assume everything will stay the same and wake up one day to find the rules have changed. The people who thrive are the ones who see the changes coming and adjust before the crowd does. Let me give you one more action step, and this one is about information, not money. Start paying attention to what central banks are doing, not what they're saying. The Federal Reserve, the People's Bank of China, the European Central Bank, the Bank of Japan, these institutions telegraph their intentions through actions if you know what to look for. When China's central bank buys less US debt than expected, that's a signal. When the Fed expands its balance sheet by buying bonds, that's a signal. When Japan intervenes in currency markets, that's a signal. These actions tell you where the smart money thinks the system is headed. You don't need to become an expert in monetary policy. You just need to check a few key indicators every quarter. How much US debt did foreign governments buy? Did that number go up or down? What are central banks doing with their gold reserves? Are interest rates rising or falling in major economies? These data points are publicly available. It takes maybe 30 minutes every 3 months to check them. And that information will tell you more about where the system is headed than 1,000 hours of watching financial news channels that are designed to keep you confused and scared. The final thing I want you to understand is this. The China dollar trap is not a conspiracy. It's not a plan that someone designed to screw you over. It's an emergent property of a complex system. The United States wanted to maintain global dominance after World War II, so we built a dollar-based system. China wanted to develop economically, so they plugged into that system. Both countries made rational decisions based on their interests at the time, but those decisions created feedback loops and dependencies that now trap both sides. Nobody's fully in control. That's actually scarier than a conspiracy, because conspiracies can be exposed and stopped. Emergent system dynamics just keep going until something breaks. Your job is not to fix the system. Your job is to understand it well enough to protect yourself and take advantage of opportunities when they appear. The biggest opportunity most people miss is simply not being fully exposed to a single point of failure. Diversify across currencies by holding international stocks. Diversify across asset classes by having some bonds, some stocks, some real estate, maybe some commodities. Diversify across time by not having all your money locked up in retirement accounts you can't touch for 30 years. Keep some liquid, keep some accessible, and most importantly, diversify your knowledge. Don't get all your information from one source. Don't trust anyone who says they have all the answers. The people who really understand this stuff are humble about what they don't know because the system is so complex that nobody can predict exactly how it will evolve. But you can understand the forces at play. You can see the incentives. You can watch the trends. And that's enough to make better decisions than 99% of people who never think about any of this. The China dollar trap is one of the most important dynamics in the global economy, and almost nobody outside of central banking and international finance really understands it. Now you do. Use that knowledge. Don't let it paralyze you with fear. Let it inform your decisions. The system will change. It always does. The question is whether you'll be ready when it happens.